Look, I'm going to be direct with you. While most people were checking their phones this morning, something happened in Tokyo that's going to change everything. I've been analyzing commodities markets and stacking physical silver for 12 years, and I can tell you, what we're seeing right now is not normal market behavior. The Japanese 30-year bond yield hit 3.91% a few hours ago. If you're not familiar with bond markets, that number probably means nothing to you. But here's what you need to understand. In the Tokyo trading rooms, there was no panic, no shouting, no dramatic crash, just an eerie, suffocating quiet as liquidity simply vanished. The financial media is already spinning this. They're calling it a fiscal tantrum or a temporary adjustment to Prime Minister Sanae Takaichi's new tax policies. The narrative they want you to accept is simple. The adults at the Bank of Japan are still in control. This is just market noise. Everything will stabilize. They're wrong. This isn't about a tax cut. This is the first structural fracture in the foundation of the global debt superstructure. And while the opening act played out in Asian markets, the main event is hitting the New York afternoon desks right now as I'm recording this. Here's what nobody is telling you. While the world watches Japan, they're completely missing the $1.2 trillion fuse that leads straight to the US Treasury market. My claim is straightforward, and I'm going to walk you through exactly why I believe it. The collapse in Japanese bond market confidence is the starting gun for a global flight into hard assets, specifically physical gold and physical silver. Think about the gravity of this moment. Japan is the #1 foreign holder of US debt. They're not some minor player. And right now, they're losing control of their own domestic bond market. When the biggest external supporter of US treasuries can't even manage their own house, what does that tell you about the structural integrity of the entire system? Here's what I'm going to do in this video. I'm going to explain the actual mechanism behind yield curve control failure. I'm going to run the math on what happens when $1.2 trillion in treasury holdings needs to find a domestic exit. And I'm going to share with you my personal battle plan for a silver market that just crossed $94. Because let me be clear about what this really represents. This is about financial sovereignty versus systemic collapse. If you want to understand why silver is surging right now, why we're seeing these kinds of moves, you have to understand the dam that just cracked in Tokyo. So let's pull this apart. I need to explain a mechanism that most people have never heard of, but it's absolutely critical to understanding what's happening right now. It's called yield curve control failure. And when you understand how it works, the current price action in precious metals becomes inevitable. Here's the simple version. Yield curve control happens when a central bank tries to force interest rates to stay low by buying every bond in sight. The idea is that by becoming the buyer of last resort, they can set the price, and therefore the yield, wherever they want. Japan has been running this playbook for decades. They've used it to hide a truly massive debt-to-GDP ratio of around 260%. By keeping rates near zero, they kept their interest payments manageable, on paper at least. Think of it like this. Imagine a massive concrete dam holding back a rising river. The Bank of Japan is the dam. The market selling pressure, people who want to get out of Japanese bonds, is the water. For years, the dam held. The Bank of Japan kept buying, kept printing yen, kept the yield suppressed. But today, the water level rose too high. And we're seeing the first structural cracks. When a dam breaks, you don't get a slow leak, you get a flood. If Japan can't control their bond yields anymore, they face an impossible choice. They can try to print even more yen to buy even more bonds, but that destroys the currency. Or they can stop buying bonds and start selling assets, including their massive holdings of US treasuries, to defend the yen. Either way, the dam is breaking. Now, let's stop the narrative for a second and look at the trigger event. Prime Minister Sanae Takaichi took office in October of 2025. Her 5 trillion yen food tax cut was supposed to be popular pro-growth policy. Instead, it became the last straw that broke the market's back. Why? Because when you're already carrying a debt load of 260% of GDP, any new fiscal expansion, even a tax cut, signals to bond investors that there's no credible path to fiscal consolidation. The market took one look at that policy and said, we're out. So here's the question that should terrify anyone holding dollar-denominated assets. What happens to the US when the dam starts throwing its $1.2 trillion in treasury reserves into the river just to stay afloat? Let me give you the market snapshot from when I was looking at the data earlier this afternoon. Gold, $4,755.74. That's up nearly 2% in a single session. Not a small move for an asset that size. Silver, $94.31. This is a staggering move. We're testing the $95 psychological barrier as I'm recording this. Japan 30-year yield, 3.91%. That's a record high that was literally unthinkable a year ago. US 10-year Treasury, 4.31%. The contagion is already crossing the Pacific. What happens in Tokyo doesn't stay in Tokyo. But here's what the official numbers don't capture. There's a massive disconnect between paper price and physical reality right now. While the paper price of silver sits at $94, the real physical market is telling a different story. If you walk into a local coin shop today, you're not buying physical silver for $94. The premiums are exploding. You're likely paying triple digits if you can even find inventory. The dollar index is caught in a vice right now. On one side, you've got rising US yields that should support the dollar. On the other side, you've got the very real potential for massive Japanese liquidation of dollar assets. And here's what I'm hearing from people who work institutional desks. And I want to be clear, these are unverified rumors, but they're coming from credible sources. The official volatility numbers look scary, but the whispers about what's actually happening behind the scenes are far more terrifying. The divergence between what the financial media is reporting and what's actually happening in the plumbing of these markets is growing by the hour. I want to address the counter-arguments directly, because if you're watching this and you're not already convinced, you're probably thinking one of a few things. Skeptic argument number one, the Bank of Japan has infinite ammunition. This is the most common pushback I hear. The idea is that the Bank of Japan can simply print unlimited yen to buy every bond and crush anyone trying to short Japanese government bonds. Here's the problem with that argument. Yes, technically they can print unlimited yen, but printing infinite yen to save the bond market leads to the total hyperinflationary collapse of the yen's purchasing power. You can save the bonds, or you can save the currency, but you cannot save both when your debt is 260% of GDP. This is the fundamental trap. Every action the Bank of Japan takes to defend the bond market destroys the currency. Every action they take to defend the currency means letting bond yields rise, which makes their debt service costs explode. There's no easy way out of this. The second myth I want to bust, the idea that gold and silver are just commodities in this environment. They're not. Right now, gold and silver are functioning as exit ramps. They are the only major assets with no counterparty risk at a time when the world's largest government bond markets are actively failing. When you own physical gold or physical silver, you don't need a bank to honor a promise. You don't need a government to make good on a bond. You don't need a clearinghouse to net out your position. You own an asset that has held value for thousands of years, regardless of what any government does. In this environment, that matters. The third skeptic argument, this is just a tantrum in reaction to the February elections. The market is overreacting and things will calm down once the political uncertainty settles. The evidence suggests otherwise. Demand collapsed at a 20-year bond auction. This wasn't retail investors having a bad day. This was institutional players, the people who are supposed to be the stable, long-term buyers, simply refusing to show up. That's not a tantrum, that's a boycott. So if the Bank of Japan is out of bullets and the institutional buyers are walking away, who exactly is left to buy all this debt? Let's do the math, because this is where the thesis either holds up or falls apart. We know the Bank of Japan is losing control of yield curve control. We know silver is testing $95. We know Japan holds $1.2 trillion in US debt. So let's run a conservative scenario first. If Japan only sells 10% of their US Treasury holdings to support the yen, that's $120 billion in selling pressure hitting a US market that's already struggling with 4.93% 30-year yields. $120 billion might not sound like a system-breaking number, but remember, this is happening at a time when the US Treasury is already issuing record amounts of debt. The marginal buyer matters. When you remove a major buyer and turn them into a seller, even a moderate amount of selling can move markets dramatically. Now let's talk about the stress test scenario. There's an unverified rumor circulating, and I want to emphasize that this is unverified, but it's coming from people who would know that Japan is preparing a $500 billion stock and bond liquidation event as early as next week. If that rumor is even 50% true, we're looking at a liquidity black hole. Think about what happens when $500 billion tries to exit positions simultaneously. The bid-ask spreads blow out, market makers step away, liquidity vanishes, and prices gap in ways that break risk models. Here's the disconnect that nobody's talking about. Gold topped $4,740 earlier today. The financial media is treating this like it's some kind of bubble top. But when you actually account for the currency debasement that would be required to bail out the Japanese banking system, $4,740 is conservative. Let me explain what I mean by that. If the Bank of Japan has to print, let's say, 20 or 30% of Japanese GDP to recapitalize banks and buy bonds, that's a massive monetary expansion. Some of that money finds its way into dollar assets as Japanese investors try to preserve wealth. That puts upward pressure on dollar asset prices, including gold. Meanwhile, the Federal Reserve has to decide, do we let Treasury yields spike and risk a recession, or do we start buying treasuries ourselves and risk reigniting inflation? Either path is bullish for gold. Now, let's talk about silver specifically, because something very interesting is happening in the silver market right now. If you go look at the Silver Squeeze hashtag on social media, you'll see what looks like retail enthusiasm. And a year ago, I would have dismissed that as just another meme trade. But this time, it's different. The institutional inverse gamma is kicking in. What that means in plain English, the dealers who sold silver derivatives are now scrambling to cover their physical shorts as the price rises. This creates a self-reinforcing loop. As the price goes up, dealers need to buy more physical to hedge their exposure. That buying pressure pushes the price higher, which forces them to buy even more. And here's the thing, there's not unlimited physical silver available at these prices. The market is discovering that right now. When the math stops making sense, the rule makers usually change the rules. Keep that in mind. Let me tell you what I'm watching, because we're moving into uncharted territory. First, the institutional reaction. If I'm right about this, we're going to see margin hikes on COMEX. They're going to make it more expensive for you to hold silver futures positions. This is the standard playbook when a market starts moving in ways that threaten the clearinghouses. Here's my dashboard of indicators to watch. Trigger 1, JGB 30-year yield crossing 4%. If we see that, we're at the point of no return. That's the level where the debt service costs become mathematically unsustainable, even with optimistic growth assumptions. Trigger 2, US 10-year yield hitting 4.5%. This would confirm that the fire sale has begun and the contagion is fully spreading to US markets. Trigger 3, silver hitting $100. This is where the mainstream media FOMO begins. When silver crosses triple digits, every financial news outlet will be running stories on it. That's when your dentist and your Uber driver start asking you about silver. I also expect to see media blackouts or narrative shifts. Don't be surprised if the framing suddenly changes to national security concerns or market stability measures to justify potential trading halts or new regulations. Because here's the reality. We are entering a rate environment that no one alive has traded before. The last time we saw yields this high relative to debt to GDP ratios this extreme, the monetary system looked completely different. We weren't in a world of electronic trading, algorithmic market making, and globally interconnected derivatives markets. The fragility is different now. The transmission mechanisms are faster, and the potential for cascade failures is much higher. If you're trying to use historical playbooks for this environment, you're going to be wrong. I'm going to share my personal opinion here, and I want to be clear that this is just one analyst's view based on 12 years of watching these markets. I believe we are witnessing the opening phase of what I would call the inflationary inferno, a period where purchasing power gets destroyed to save the banking class. The central banks have painted themselves into a corner. They can't let the bond markets collapse without triggering a financial crisis, but they also can't print unlimited money without destroying their currencies. So what do? They choose the slow motion currency destruction. They choose inflation over deflation every single time, because inflation allows them to nominally pay back the debts, even as the real value of those payments shrinks. Here's what I'm doing personally. I'm watching the $100 silver level with extreme caution. If silver breaks $100 on high volume, I expect a massive margin hike from the exchanges within days. At that point, I would sit on my hands rather than chasing the peak. My if-then strategy is this. If Japan begins a verified fire sale of US treasuries, not rumors, but confirmed sales showing up in the custody data, I'm personally looking to increase my physical metal exposure. Because at that point, the dollar volatility becomes untradeable for normal people like us. I don't think we're looking at a market crash tomorrow. This is in October of 2008 all over again. This is a slow motion currency devaluation that plays out over 12 to 24 months. The safe haven trade into physical metals is just beginning in my view. But my opinion doesn't matter as much as the data on your screen. So let me bring this home. Let's recap what we've covered. Japan has lost control of its bond market. The dam of yield curve control is failing after decades of holding back market forces. And precious metals are reacting exactly as you would expect when the foundation of the global debt structure starts to crack. Gold is over $4,750. Silver crossed $94 and is testing $95. These aren't just numbers on a screen. They're the market's way of saying that the old rules no longer apply. This is the opening salvo. The biggest financial crisis in history doesn't happen in a single day. It happens 1 basis point at a time. It happens when a bond auction fails here, a yield spikes there, a currency swap line gets activated somewhere else. The cracks compound, the stress builds. And then, at some point, the structure fails in a way that seems sudden but was actually years in the making. We're in the years in the making phase right now. Most people won't recognize it until it's too late. But you're watching this video, which means you're part of a small group that's paying attention while the rest of the world is distracted. Things are moving fast. The story is evolving as I'm recording this. By the time you watch this video, we might already have new developments. If you want to understand the inventory dynamics that led us to $94 silver, the physical shortage that's been building in the background while everyone was focused on paper prices, go watch my previous video on COMEX drainage. The supply side of this equation is just as important as the demand side, and I break down exactly what's happening in the physical market. The Japanese bond market just sent a signal. The question is whether you're listening. Because when the dam breaks, and it's breaking right now, you don't want to be standing in the valley wondering why nobody warned you. The water's rising, the cracks are spreading, and the exit ramps into physical assets are getting crowded. Position accordingly.